If you want to learn how to trade options, purchase my ebook located in the description below. If you're seeing this on TikTok, it is located in my IG bio. So how did I make $42 just trading a single Apple call option? So on January 22nd, I got into one call option at 11:49. So looking at Apple on January 22nd, 11:49, which is this candle right here, right? Yeah, 11:49. I got into, I don't know why this thing keeps moving back. So I got into one call option on this candle, the 12 candle, as soon as it landed on the 50-day moving average. So basically the plan was to buy a single call option once it landed on the 50-day moving average and then exit out the position once it's up 5 or 10%. And once the position was up 5%, which was a $42 gain, I sold out the position, making a $42 gain just trading a single Apple call option. And basically the day trading rule is basically you kind of want to if you're day trading, right, the rule is that step one, buy into an oversold stock that you think is oversold, right? But try to analyze if where you're getting into that stock is a good entry point, right? And then step two is to sell out the position as quick as you can, right? So basically once the position is up 5 or 10%, right, sell out the position for a small 5 or 10% gain, and then rinse and repeat that cycle over and over again, right? And basically throughout the day you kind of want to analyze other stocks that are probably at a good buying opportunity, right? Or if you're playing put options, you could always play put options on stocks that you think are a little bit overextended, right? And so usually I tend to stick to playing more of the call options side, really. I don't really like to play put options. For some reason when I play put options, it kind of backfires in a way, sort of. But that's because really, if I'm being honest, I've mostly tested this strategy out more with I guess you could say I've tested this strategy out more with by playing call options. So when I've done put options, I don't really have I guess you could say a specific strategy set in motion when I play put options. It's the same thing, right? But sometimes I don't know why. For me, right, I don't know if it's just a me thing or not, but when I usually play put options, it just, for some reason, those trades do not go well. And sometimes all of a sudden those trades, instead of going down, right, instead of that stock going down, all of a sudden it goes up. And so I don't know, maybe it's just a me thing because I probably don't know how to analyze if that stock will keep going down. Meanwhile, I do know how to analyze a stock when I think it's going up. So I don't know, I think it's just more of a me thing, honestly. But usually I just like to stick to playing call options. I try to stay away from playing put options, and the reason I stay away from playing put options as well too is because number one, I'm not sure if you guys know what hedge funds are, but basically hedge funds are I don't know what they are, but basically they're like let's say like, I don't know, they're like a head, like a how do you say, I guess you could say they're like people that bet against like stocks, right? Well, that's basically what it is. There's basically people that bet against stocks, and basically their whole goal is just to make money off of playing shorting a stock. So basically shorting means like, oh, I think that company is gonna go down throughout the year, right? Or they feel like that particular company isn't successful anymore, right? So what they'll do is they'll short that stock, right? And usually what the market tends to do is it kind of tends to outperform those hedge funds, if I'm correct, right? I read an article somewhere out there basically saying that usually the S&P 500, or I guess the overall market, tends to perform a little more better than what hedge funds returns could be. So basically hedge funds returns are a little, not so good. Meanwhile, the overall stock market's performance and returns, right, is a little more better than if you were to, give your money to a hedge fund to trade, right, and give you a slight return, right, on your money. So basically, in a way, I try to, just, buy oversold quality stocks, right? Don't buy, like unknown quality stocks, right? You want to buy, recognized name companies, right? Because if you buy like a not so recognized company name, right? There's a, higher chance that that stock could possibly disappear one day or really make you no money, right? So basically, there's two strategies I have in mind right now. So the first strategy is basically step one, buy SPY when it's oversold, but specifically buy a 30-day call option, right? And then step two is to sell out the position for a small 5 or 10% gain. Once the position is up 5 or 10%, you sell out the position for a small 5 or 10% gain. And then step three is just to rinse and repeat that cycle over and over again once you observe that, SPY is oversold, right? I've tested that strategy out lately, but really I can't really test that strategy out right now, due to the reason that me personally, I feel like right now SPY is way oversold, right? And so when I see that, SPY lands exactly on the 50-day moving average, I'll buy a couple of call options, right, that expire within 30 days, right, and then sell out the position for a small 5 or 10% gain. But the goal is to obviously not waste all your money in that one spot. You're basically trying to dollar cost average, and what that means is basically, let's say you bought a little bit of call options once it landed on the 50-day moving average. Now what you want to do is buy more call options in case it lands on the 20-day moving average. So if it lands on the 20-day moving average, that's the next opportunity that you want to look into, right? That way, when, let's say all of a sudden, right, SPY lands on the 20-day moving average, right, and it uses it as support, it can bounce off of it and it can make your position in the green a lot more faster if you instead of you just had you only bought on the 50-day moving average. So basically that is pretty much it. Oh, and I forgot to say the second strategy is basically the same with oversold mega cap stocks, but those you basically tend to buy expiration dates anywhere from 30 days to further out, right? And that's pretty much it. I'll see you guys in the next video. As always, take care. And as always, it's not financial advice. As always, do your own research. I'll see you guys in the next video. As always, take care and bye.